We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jesse Felder, founder of the FelderReport.com. Jesse, thanks for joining me today. How are you?
Good, Tom. Good to be with you. Thanks for having me back.
I always look forward to speaking with you, Jesse. You know, even though our appearance is almost mirrored, you know, we have some different views, but I always appreciate getting to dig into your work, read through a bunch of your blog, your material, and really get a sense of where you see the markets are right now. So why don't we start with basically this overvaluation that you see right now? Where do we see this particular overvaluation, and when was the last time we saw it at these extremes of basically the forward value versus actual price of much of the equity markets?
Yeah, well, I just put together kind of a new equity valuation composite that puts together the Buffett yardstick, the Q ratio, the Shiller-Cape ratio, and price to, real price to the exponential trend of the S&P 500. Basically, like price to sales, price to book, price to earnings, and price to just long-term trend, and into an equal weight composite. And no surprise, because a lot of these individual metrics kind of show this, but the stock market is more overvalued today than it's been at any point since 1950. A lot of the data that I use goes back to like 1949, 50. And so in the last 75 years, we haven't seen the stock market as expensive or overvalued as it is today. The nice thing about this measure is it has a really high correlation, negative correlation with future returns over 10 years. And so right now, it basically, as Warren Buffett famously said, the price you pay determines your rate of return. You pay a high price, you get a low rate of return. Vice versa, you pay a cheap price, and you're going to get a terrific rate of return. Mm-hmm. And so the fact that investors today are paying the highest valuation, highest prices on record in 75 years means they're likely over the coming decade to get the worst returns from owning stocks. And like I said, there's more than a 90% correlation between this metric and future returns. The last time it was really anywhere close to this was at the peak of the dot-com bubble. Mm-hmm. And some may remember that after the top in 2000, we saw a lost decade in the stock market where it took 12, 13 years for prices to even just get back to their dot-com bubble highs. And so that's kind of the lesson from valuation. When you get such an extreme valuation as we see today, your upside is extremely limited, and you have significant potential downside. And your average return over the coming years is likely to be relatively poor. And so the risk reward is just not skewed in favor of the bulls right now.
So Jesse, what are some of the other metrics that you're looking at? I think getting a grasp of the overvaluation of a lot of these companies, versus future returns is understandable. But what about the narrowness of the breadth of this market as well?
Yeah, that's a great question. A couple of the indicators that I've looked at are, Hindenburg omens and Titanic syndromes. And these basically measure, when the stock market's hitting a new high, how many stocks under the surface are actually participating versus how many are actually making new lows. And you get these Hindenburg omens and Titanic syndromes triggered really only when there's a large number of stocks making new 52-week lows at the same time the index is making a new high. But And that's typically a warning sign, and so we've seen more Hindenburg omens and Titanic syndromes over the last 12 to 18 months than really ever before in the stock market. One measure that I think is really interesting right now is the number of days that the stock market over the past 12 months has managed to rise with less than 200 of the 500 stocks actually advancing. So very narrow advances. And at the peak of the dot-com bubble, over a 12-month look-back period, we saw 13 trading days. And this was really kind of mostly in early 2000. We saw 13 trading days where the market rose. S&P 500 index went up with less than 200 of its components actually driving those gains. Over the last 12 months now, I mean, that was 13 was that peak. We never literally saw anything similar any time before or after that. It was really a very rare narrowness to that market peak. Well, over the last 12 months in the stock market, today we've seen 19 days where the S&P has risen and less than 200 stocks have managed to push the index higher on those days. And so the peak of the dot-com bubble was 13. We've seen 19 recently. And as I said, we've really never seen more than 3 or 4 days in a given 12-month period outside of those two episodes. So this is a very clear sign that this rally, the advance in the stock market, is extremely narrow, and that's a pretty bearish sign as to the health of the overall trend.
Mm-hmm. Well, Jesse, of course, we've seen a lot of insider selling recently, and this, of course, isn't let's say a perfect marker of the top in markets, but could this be a recognition by a lot of them that understand that stocks don't only go up all the time?
Yeah, it's something that I've watched closely for my entire career because people will say that insiders sell for a number of reasons. They only buy for one, and usually that's the case. I'd say most of the time that's the case. And so insider buying is usually a pretty good sign in individual stocks that the top CEO, CFO are really bullish about the company's prospects and think the shares are fairly valued or undervalued. And so, insider selling on individual stocks doesn't necessarily have the same kind of connotations. It sometimes is helpful, when you see, like insiders at WorldCom and Enron back in the 2000-2001 timeframe, literally liquidated all of their stock before those companies went bankrupt. And that was a pretty good sign. Most of the time, it's not as clear cut as that. But when you put it all together in aggregate and say, I want to look at all of the insider buying relative to all of the insider selling, that is actually one of the best economic indicators for the coming, 2 years and coming 1 to 2 years in stock prices that you'll ever want to find. And so when insiders in aggregate are very bullish, the stock market and the economy typically does really well 12 to 24 months out, and vice versa. And what we've seen over the last 12 months really is the insider sell to buy ratio has been persistently bearish for longer than we've really seen it in history, at least in the last decade. The only times that we've seen it come close is really the end of 2021. We saw insiders bearishness around these same levels. And what I'm talking about is a 12-month insider sell to buy ratio that's around 20 to 25. So $25 sold for every dollar purchased. The bullish side of that indicator is when it gets down around 10 and you have only $10 sold versus $1 purchase. So we're sitting at this 25 level of $25 sold for every dollar per purchase. And we've been sitting here for a year. So this is a very clear sign to me that insiders are not bullish on stock prices or the economy and earnings, these types of things over the next 1 to 2 years. Usually a really good indicator of what's yet to come.
Mm-hmm. Yeah, almost like foreshadowing the pulse of what they're seeing in their, let's say, forward guidance, right?
Absolutely. Yeah.
So Jesse, when we take all of these things together, these three major indicators together, does that paint, one of the most bearish times to be invested in the stock market at this point?
Yeah, and there's one other thing that I would point to. I think you have extreme valuations, you have extreme bearishness on the part of insiders. And we've had over the past year extreme bullishness on the part of investors, and namely foreign investors, foreign inflows into the US stock market. We saw it recently, prior to this recent correction we had the, almost $500 billion in a trailing 12-month inflow into the U.S. stock market from foreigners. And the previous peak, record peak, was in late 2021, right before the 2022 bear market. The previous peak before that in foreign inflows was in late 2007, right before the financial crisis. And the previous peak before that was just under $200 billion at the peak of the dot-com bubble in late 2000. Mm-hmm. And so what we've had, part of what's been driving this is very narrowness within the rally, and it's a lot of foreign inflows into the U.S. stock market, that have kind of driven this rally. So, but these peaks, that Justin Mamis was a famous market strategist on Wall Street, wrote several books, and he used to say foreigners and dentists are always the last to buy. And so what we've seen is this peak in foreign inflows. And I think so the fact that you've now had extreme valuations, extremely narrow breadth, extreme bearishness on party insiders, and a peak in foreign inflows into the U.S. stock market that could potentially be exacerbated by a rolling over in the dollar. It's a very precarious time, I think, in the U.S. stock market right now.
So when you think of let's say a revaluation of these equity markets, Jesse, what do you see as the most likely path forward for this type of rebalancing? Is it a slow grind down, or is there a possibility of some cataclysmic kind of dramatic crash sparked by some extrinsic event?
Yeah, I mean, it's really impossible to know, but the extreme valuations, I think one of the main things, and I think this isn't been missed by the mainstream media, but the fact that discouraging foreign capital in the U.S. markets by tariffs, basically trying to reduce the trade deficit, means you're going to give trading partners are going to end up with fewer dollars. They're going to have fewer dollars to reinvest into the Treasury and equity markets. Mm-hmm. And so I think, the dollar is really the key thing to watch here, because if the dollar does begin to, it's already had a significant decline. The decline in the dollar in the first half is the weakest first half since 1973. Some people may remember the 73-74 bear market in stocks was one of the worst on record, very painful. Not only because nominally prices went down 50%, but also inflation was running high. So real returns were even more deeply negative. And so, I think it pays to people are not paying enough attention to the dollar right now. Because if the dollar continues to roll over and it does inspire foreign money to leave the market, what we've seen in those episodes, right? So look back at those times I mentioned before, those peaks in foreign flows. The after those peaks was the 2022 bear market, was the 2008 bear market, was the 2001, 2002 bear market in U.S. stocks. So this peaking and rolling over of foreign equity inflows, potentially exacerbated by a very weak dollar and a dollar downtrend, could play catalyst for a bear market that would be more significant than what we saw just in March and April of this year.
So if the value of the dollar keeps going down and the foreign holders of these dollars see that, is that part of maybe the start of a self-reinforcing cycle that gets foreigners to want to dump more dollars?
I think so. I think one of the things that I think is an indicator that's worth paying close attention to, or just understanding, is the fact that the trend in the dollar has been a really good indicator of whether you want to favor financial assets or real assets in your portfolio. When the dollar's going up, usually stocks and bonds do better than things like commodities and precious metals, et cetera. When the dollar's going down, commodities and precious metals usually do a lot better than stocks and bonds. And so, you could see that the dollar ran up from the mid 90s into the peak of the dot-com bubble, rolled over in 2002. And at that point, when the dollar kind of broke and rolled over from 2002, was a great time to, overweight things like energy and precious metals, right? The bull market in oil energy stocks, precious metals from 2002 to 2011-ish was a wonderful decade for investors in real assets. Since that time, really since that 2011 timeframe, dollar bottoms, and we've had a dollar bull market really for over a decade, really since 2011, and it's paid to favor stocks and bonds over real assets. But with the dollar rolling over, breaking down below 100, kind of the key $100 level in the DXY. I think to me that's a clear sign that, hey, it's time to start favoring commodities and those types of investments over financial assets again, which are going to struggle, especially with foreigners being so overexposed to U.S. assets, financial assets right now.
Well, yeah, as you said, there's that peak of foreign investment right now, but conversely, let's say, on a demand side for the dollar, most central banks around the world, around the rest of the world, other than the US, have been lowering interest rates already. How does the interest rate drive demand for dollars relative to the rest of the world being, let's say, at a lower interest rate?
Yeah, I think all else being equal, interest rate differentials are an important driver of currency returns, right? Currency, demand is a lot of times driven by investors saying, okay, where am I going to get the most money for my, the most interest return on my investment? And money flows there. But what's going on today is the dollar's not responding to interest rate differentials for a number of reasons. And I think one of them is, what's going on with fiscal policy, right? With the big beautiful bill potentially blowing out the deficit even further, and then also Trump attacking the independence of the Federal Reserve and saying we need 1% interest rates, even though we're going to blow out the deficit. And we're going to, it's very, very clear that Trump wants to address the debt with financial repression. We need inflation above the level of interest rates, so the cost of debt is manageable. That's a very clear message to investors that the value of the dollar is not going to be tomorrow and the day after and the year after anywhere near what it is today. It's the intention of the powers that be to devalue the currency, and so I think that's kind of one of the drivers right now. Another one, obviously, is, as I mentioned before, the tariffs. Is that if you say we want to narrow the trade deficit, that means we want you to own less of our assets. We want you to end up with less dollars based on trade that you're going to recycle into our asset markets. And so narrowing the trade deficit means you're going to end up less dollars and have that less money to recycle into those assets. So I think interest rate differentials today are not as important as a driver as they were before. The one other thing I would point out, though, is yes, interest rates are lower around the world, but what are the trends, right? The trends in Japanese yields are higher, right? And the trends in U.S. yields, at least on the short end, are lower, right? The last move by Jay Powell and the Central Bank Federal Reserve was to cut interest rates. Last move in Japan is to raise interest rates. Japan's likely going to need to continue to raise interest rates to rein in inflation and normalize what has been extremely dovish policy over there. And so the trend in those is really important. I think that's why one of the things I look at is institutional investors have a record-sized bet on long yen right now. And that bet is basically saying that, yeah, Jay Powell's going to have to cut interest rates to deal with a weak economy. And the Bank of Japan is going to have to continue to normalize policy. And all the money over the past 15 years that is flooded, from a carry trade. Let's borrow money in Japan at zero or negative interest rates and invest it in, nominally positive yields in the United States and Mag 7 stocks and all that stuff is going to have to reverse course, and it's going to be very, very bullish for an extremely undervalued yen. That's potentially an unwind of the carry trade would be very, very bearish for risk assets in the United States. So all these things kind of fit together.
It's almost like a reverse carry trade of the last, let's say, 30 years.
Yeah, well, I mean, it would be an unwind of the carry trade. Exactly right. Is that like, hey, wait, all of a sudden we're getting actually 1.5%, something like that, on Japanese 10-year yields, when for the longest time they were, nothing. And and so it's getting more costly to borrow in Japan to kind of pull off that carry trade. At the same time as the prospects for returns from your money in the United States are dwindling if the Fed's going to be forced to cut rates because the economy is weakening. I mean, the ADP report today showed a decline of 33,000 jobs, 45,000 jobs at small businesses last month. I think it's becoming clear that the economy is weaker than anybody anticipates. Fed may have to cut rates even if inflation is elevated, and that's very bearish for the currency.
Well, Jesse, how do you look at, let's say, the attitude of Jerome Powell right now, not wanting to cut rates and just continuously really trying to, I think it's in some ways, look after his legacy and trying to be, as he says, dependent on the data.
Yeah.
What do you see as the difference once Powell's term ends in, I believe it's May 26, and Trump appointing somebody that is far more complementary to his goals?
Yeah, it's a great question. I would just start by pointing out that, Powell only seems hawkish relative to the policy that we've become accustomed to after the great financial crisis. Right? He's only hawkish relative to 0% interest rates. If you look at the Taylor rule, which is basically designed to show what a neutral interest rate policy would look like, a neutral monetary policy would look like. The Fed's, even after all the rate hikes and everything over the past 3-4 years, never even got the policy rate back to where the Taylor rule would said it should be. So policy still remains and never, and has always been throughout Powell's term, dovish relative to the Taylor rule. Now that is still a departure from history. Even back in the 1970s, monetary policy, the Fed funds rate was raised above what the Taylor rule would recommend. During the cycle, we've never seen a hawkishness that even Arthur Burns was able to implement during his term. So to say that he's hawkish, I think, is only relative to the past 10, 15 years. Policy is probably where it should be right now. What Trump has said he wants is somebody who is going to be not loyal to the Fed's mandate, but is going to be loyal.
Putting it
is going to be loyal to his his policy prescriptions, his fiscal policy. Basically, he wants somebody who's going to commit to fiscal dominance. We'll do whatever it takes to support fiscal policy, support the Treasury. Now, that is, I think, another reason why, as I said, Trump undermining the independence of the Fed, another reason why the dollar is behaving the way it is, despite interest rate differentials that say it should be stronger. So I think appointing the most dovish possible candidate, which is what he's basically said he wants to do, is just another going to be another dollar bearish thing, and it's going to be mean that we're going to be living with inflation above target for years to come.
Jesse, I've always had a difficult time, let's say, separating the type of inflation that we saw from 2008 to basically 2019, asset-based inflation, versus the type of inflation that we got from the direct monetary type stimulus. And if they stick with, the fiscal side, basically, as you said, committing to fiscal dominance, does that not just create more asset side inflation and not necessarily consumer price-based inflation?
It's a great question. I think that it's a very complicated answer. I think that what is going on the fiscal side is that it's really Social Security, Medicare, these types of things are growing so fast, these entitlements. I mean, that's part of it. Also, another big part of the deficit is obviously interest expense right now, which is why Trump wants lower rates. And so with interest expense driving costs so rapidly, and then the demographic challenges associated with Social Security and Medicare, aging society, right? It means that the costs of these programs are growing, unsustainably. At some point, they're going to have to be reformed. And so I think there's kind of that it essentially represents fiscal stimulus because they're growing faster than anything would, justify them. These basically transfer payments. We're sending people Social Security payments, and we're paying for healthcare, and all this stuff. That's really what it is. Now, I don't believe that is easily manifest itself into asset price inflation as inflation in the real economy. So, and this really just kind of comes back to the demographic issue. Right, demographics was perhaps the biggest driver of disinflation over the past 50 years, really until 2019, as you pointed out. And it was demographics and globalization, right? So we had at the same time the baby boomers came into the workforce, 80s, 90s, in their peak earning years, right? That represented a huge boom in the supply of labor that helped lower costs, right? You have more employees fighting for fewer jobs. Companies can afford to pay less. And so it kind of keeps costs down. At the same time, we can ship jobs overseas and even lower cost even more that way. So a huge disinflationary force to lower costs of production by offshoring production and by having the labor force grow relative to the overall economy. Both of those trends are now in reverse. So we have a shrinking population of workers relative to the overall population of society. Fewer people to do all the jobs that need to be done puts pressure on wages, right? Wage growth has to go up, cost in the economy goes up. Same thing with de-globalization. We can't offshore production anymore. So if we want to build it here, what's going to cost iPhone's going to cost $3,000 if you want to build it, in the United States instead of $1,000 or whatever. So you apply that across a number of different things in the economy. So this deglobalization and demographics are, I think, the main factors to consider, even above kind of the fiscal thing. I mean, they're really the trends underneath what's going on, the fiscal thing. And so I think that, that's what creates inflation in the real economy now. And there's been a couple of great books, on the subject. The Great Demographic Reversal is one I'd recommend everybody read because it really is a roadmap as to what to expect. The paradigm shift in economies and markets that's kind of underway right now, and will drive inflation to manifest in prices in the real economy rather than asset prices going forward.
Mm-hmm. I think demographics is such a big thing that we don't always necessarily consider. We maybe look at the markets and think that the type of demand and behavior of the markets based on this population is just going to continue in a static way. But I think demographics are always a good thing to really to back out and consider, because it's such a giant force within the markets too.
Well, there's so much noise from day to day in the markets, right? There's, Treasury, Bitcoin Treasury companies, and, all kinds of, madness going on day to day, Tesla's deliveries, whatever, that it's really hard to kind of stay focused on these big picture things and to remember that what is driving these longer term factors are things like demographics and deglobalization. And, but it's probably more important than ever to remember that, because they do represent a paradigm shift that's going to drive, longer term trends in all of these asset classes, for years to come. So yeah, it's very easy to get caught up in kind of short term noise and lose sight of the fact that these are the main things to pay attention to, because they're going to be, the next 10 years is going to look a lot different than the last 10.
Mm-hmm. So does this mean that we're looking at basically a stagflationary possible next decade in your view?
Absolutely. Yeah, I think that's absolutely right. I think right now, especially, we're seeing a lot of weakness in the economy. That's kind of one of the things that this insider sell to buy ratio points to, is that earnings and economic growth revenues are all likely to kind of disappoint over the next 12 to 24 months. And we're already seeing signs of it, like in the labor market, in ADP job report, and these things are showing kind of clear signs of weakening. At the same time, leading indicators of inflation, which is ISM manufacturing prices paid, shows that inflation is coming. The tariffs and these things are going to lead, and falling dollar. Right. That's one thing too that we haven't maybe talked enough about is, you look at the trend in the dollar, it leads commodity prices by about 3 months. And so this steep decline in the dollar that we've seen recently is a pretty good sign that commodity prices are going to take off potentially over the next quarter. Copper prices already doing that. We've seen some nice strength in the copper price. Gold price, I think, is a really good leading indicator of what to expect from commodities over the next 6 to 12 months. Mm-hmm. Oil especially is dramatically undervalued right now. It's very, very cheap, and the supply demand is setting up to be very, very bullish over the next several years. So I think if you start to see oil prices really pick up, at the same time we start to see more signs of a slowing economy, then the stagflation narrative is really going to grow, and people are going to start to realize, oh wait, maybe paying record price to earnings ratio for stock market is not great at a time when earnings are going to likely disappoint.
Mm-hmm. Well, Jesse, before we move into more of the commodity side of things, you kind of mentioned this idea of the Treasury / Bitcoin demand there. So how important do you think this mechanism of stable coins wanting to buy treasuries to back their value, how important of a new demand vector is that going to be for treasuries?
I mean, it's a good question. I think there's a lot of demand for T-bills, for treasuries on the short end, mm-hmm. right? I mean, you can get a guaranteed 4.5% over a very short period of time. Wonderful. And I think to people that have gotten used to 0% interest rates post the great financial crisis, 4.5% looks fantastic. And I agree, 4.5% without risk is a really nice gift, from short end of the yield curve right now. I'll say the demand for long-term treasuries is probably not going to be enhanced by any stable coin kind of thing. It's not going to be enhanced by the tariffs and narrowing the trade deficit. I don't know where the demand, and I think this is why the administration right now is talking about. I mean, they even proposed we're not going to issue anything, any longer dated treasuries right now, because it's I don't think the demand is there, and I think that, I mean, imagine right now, right? We're sitting here with a weakening economy. We get this ADP print. We get long end of the yield curve going up. Right? Normally, you get these recessionary type of indicators, and long-term interest rates come down. People say, "Okay, that's the time to buy bonds." It's not acting that way right now, and that's an important sign that the markets are telling you. If we go into recession, it's going to blow out the deficit, the fiscal deficit, even wider, meaning that more treasury issuance needs to come. Supply of treasuries is already outweighing demand at the long end, and if that supply were to explode, I mean, we are already issuing more T-bills relative to the rest of the yield curve than we normally would, given the economic circumstances. Scott Bessent was very, very critical of Janet Yellen doing this, but he's now doing the same thing. And that's because they know the demand is not there at the long end of the curve. And that's a very important thing to recognize. And why is it not there? Because who wants to tie their money up at 4% for 10 years when you know that the person, at least in office today, wants to devalue those dollars that you're going to tie up for 10 years and wants inflation to run higher than that interest rate. So that you'll have, they want you to have a negative rate of return, real rate of return from owning those things. So I think I think that the demand for the long end is really where people need to be focused. And it's a real problem, and it's not going to go away until we start addressing kind of the fiscal situation.
Mm-hmm. Jesse, of course, you mentioned that the dollar really leads commodity prices fairly reliably. How does the gold or oil to gold ratio also instruct us in understanding a lot of these valuations and kind of the path forward as well?
Yeah. Well, it's really difficult to kind of come up with, what's fair value for the gold price? What's fair value for the oil price, copper, a lot of these things. A lot of people look at real interest rates, essentially like TIPS yields, to understand the trend in gold. And usually there's a good correlation with those real interest rates and the gold price, which can be helpful. Right now, that suggests that the gold price is a little bit overvalued. It's gotten a little bit ahead of itself relative to real interest rates. And so it might be that gold is a little bit overvalued in the short run, or that real interest rates are going to come down and kind of justify the move in the gold price. But one way that's, I think, helpful of looking at commodities is to compare them to each other. And this is something that Lee Gehring and Adam Rosenzweig do well in their analysis. And they've pointed out that the gold to oil ratio recently spiked really, to its second highest level ever. It was really only during the pandemic that it spiked higher than it is today. You can reverse that and just look at oil to gold ratio. And the oil to gold ratio suggests that oil is about as cheap as it's ever been, except during that pandemic timeframe when oil price went negative, obviously, right? Briefly negative. Oil is about as cheap as it's ever been, or cheaper than it's ever been relative to the gold price today. And I think that's fascinating because the supply dynamics in the oil markets are shifting in a way they haven't done so in decades. And I recently did a podcast with Lee Gehring on this topic, who, his analysis I think is some of the most interesting stuff that I read. And he points out that we usually get these huge supply booms in the oil market that drive a bear market. Towards the end of those supply booms, when that kind of new supply growth is running out, that's when a new bull market is born. And so we saw a huge supply, boom in the 90s relative to the North Sea oil and oil fields in Mexico. Created a bear market in the 90s that kind of bottomed in that 2001, 2002 timeframe, when that growth really kind of started to moderate and slow down. Meanwhile, demand continues to grow even while supply growth stalls. And so then that's how you get a rebalancing and then a huge bull market in the 2000s. Well, since early 2000s, right, a lot of that in the financial crisis, right, fracking was developed in the mid 2000s. And after the financial crisis, interest rates came way down, and all of these fracking companies borrowed tons of money to go invest in this new technology and create a huge boom in supply of oil here in the United States, right? Famously, now we're oil independent and all this stuff. But this boom in oil supplies, that's been the result of the boom in fracking, growth is really moderated. You look at things like drilled but uncompleted wells are hitting multi-year lows right now. So the potential supply coming from fracking is really the lowest that it's been in years and years. And growth actually poised. Growth in production is poised to turn negative sometime, over the next year or two. So we're at another point in time where supply growth is really stalling. The supply boom that we've seen is over. And meanwhile, demand for energy is continuing to climb and hit records, right? Now we have we're trying to onshore all this production into the United States, reshore production, reindustrialize. At the same time, a lot of these companies like smelters and things in the industrial sector are competing with AI companies for energy generation. They're trying to build these huge AI data centers. So the demand for energy is growing rapidly. At the same time, supply of production is really falling off. And that sets the stage for another major bull market in the energy sector at a time when investors have never had less exposure to energy. I think energy sector is like 2.5% of the S&P 500 right now, one of the lowest it's ever been. And so it's just a very compelling situation set up in energy, I think, right now.
Well, of course, this underinvestment in a lot of the oil equities and just commodities and resources in general obviously creates this very cyclical type of high prices, kind of forgetting about the exploration side and developing the infrastructure. And it makes this kind of very predictable cycle. But, to add to this already difficult problem on the supply side, how did the Iran-Israel conflict affect this supply picture, and especially the supply picture going forward?
Well, I think that I think a lot of people looked at like the trading in the oil market in the middle of that brief war, if you want to call it that, as being very bearish for oil. Is that look, even you get a war in Iran, we're bombing Iran, and you can't get the oil price to really go up much, then that, people take that as saying, okay, well, look, the markets aren't nearly as tight as we believe. We are now energy independent. We're not as dependent on Middle Eastern oil as we were back in the 1970s. So there's all this rationalization around the idea that the oil market is well supplied. And that, but I think that really is giving people a false sense of security, and that the really what's going on in the oil market right now is driven by the futures speculating. Right, we've seen there's been very little interest at all in investors owning energy. You can see that in the managed money component of the commitment of traders report. There's just, the asset managers don't want to own any oil futures. They don't want to own energy stocks. They don't want to own anything. And so there's a lot of that bearishness can be perpetuating, is that, okay, we're bearish on energy. We think the market is oversupplied right now. We're worried about recession. I think that's one of the main drivers of energy bearishness right now, is worries about the demand side. When really they're losing sight of what's going on the supply side, and it's going to be the driver. So I think there's just a lot of this bearishness, but I think it's important that oil price is still above its lows. Still, I think it bottomed in the 50s several weeks ago, if not a couple of months ago, and is now kind of pushing back towards 70 again. And so, yeah, it didn't spike in the way some people were worried about during the Iran thing. But, now there's, nobody's talking about conflict in the Middle East, and the oil price is rising and it's well off its lows. To me, that's showing that the market is starting to price in some of these longer term dynamics that will be, play a more important role in the longer term trend.
Mm-hmm. So, Jesse, when we think about, or going back to doing some research for today, I read one of your pieces and you said that basically people aren't, or are discounting, or aren't taking into consideration that Chevron and Exxon could become direct electricity suppliers. Where does that idea come from?
Well, a lot of what these companies are producing, a lot of the frackers, are producing. We're producing natural gas almost by accident, right? We're trying to produce oil, and we're getting all this gas, and they just flare off all this gas, and now we're finding that this gas is going to have uses, right? We're finding ways to kind of ship it. There's a huge arbitrage to be had between North American natural gas prices and European natural gas prices. We're through liquid natural gas. We're now exporting to meet that demand and kind of take advantage of that arbitrage. But also, you look at the demand for electricity right now is soaring in a way that we really haven't seen for decades. A big part of that is AI, is building out these monstrous data centers that just require so much energy. But as I said, the reindustrialization of the economy, reshoring of production, that's another major driving factor too for energy demand. And so you can kind of combine these things and you go, okay, we need to ramp up electricity production. Nuclear is probably the smartest way to do that, but that you can't do that in any period of time, right? It takes years and years and years to bring that online. You can bring on natural gas fired power plants much, much faster. And we have an abundance of natural gas in the United States. And so I think that's where there's an opportunity in these stocks where people realize that we're not going to have an overabundance of natural gas for much longer, because we're going to find ways to utilize it, and probably electricity generation is one of the main ones.
Mm-hmm. Jesse, thinking about how, let's say, seeing the gold price at all-time highs and really not having a problem kind of staying there. Obviously, it's pointed at that much of this demand came from central banks, and especially Eastern central banks, buying gold as a neutral reserve asset. Do you see this trend kind of continuing until maybe we see a new Bretton Woods type agreement reached or implemented?
Yeah. There are a lot of parallels to what the Trump administration is doing today to the 1971 Nixon shock, right? The Nixon shock was basically, I think Paul Volcker was assistant to the Treasury Secretary. He's one of the top guys at the Treasury, and was noticing the gold flying out of the vaults as, our foreign trading partner said, okay, look, I don't want to hold dollars. And you guys have said you'll convert those dollars to gold bars on demand. Your fiscal situation is out of control, and so we'll take the gold. Thank you very much. To the point where Paul Volcker said, okay, we cannot allow our gold reserves to fall below $10 billion, I believe was the figure at the time. It was getting down to that figure, and so they had to close the gold window. Say, okay, no longer is the dollar convertible because we can't afford to lose all of our gold reserves. I think that's kind of similar to what's been going on today, right? If central banks buying gold, right? They're exchanging their dollars for gold. They're doing exactly what they did, and for the exact same reasons. We don't want to own dollars. We want to own gold. Very, very similar. So Nixon was able to close the gold window to put that at an end. At the same time, and this is kind of what fewer people, I think, remember or are aware of, is that Nixon applied a 10% tariff to all major trading partners as part of a process of negotiating the value of the dollar lower, right? I want to renegotiate all of your currencies higher. And what's going on today? A 10% across the board tariff, and Trump trying to negotiate trade deals. Well, I think a lot of these trade deals amount to just merely, we think the Chinese yuan is undervalued. We think the Japanese yen is undervalued. We think the Taiwan currency is You guys need to revalue all your currencies higher. We want a lower dollar.
I was going to say, or conversely, we want a lower dollar to rise.
And so they prefer to say, we think your currency should be stronger. And there's truth in that. I mentioned the stock market being extremely overvalued. The dollar, until the last 6 months, was also extremely overvalued relative to the major trading partners. And so now it's falling back closer to kind of fair value. But I think the message there is that, I don't know if it's a Bretton Woods or whatever, but they're already negotiating right now, I think, a weaker dollar relative to a lot of these things. And I think that's going to be a key component of these trade deals, is allow your currency to strengthen. Bank of Japan. Bank of China. You need to allow your currencies to strengthen. Mm-hmm. And so that kind of feeds back into what we were talking about at the beginning, right? A falling dollar, a trend in a falling dollar is going to be, is a very clear sign that investors ought to be more worried about financial assets, right? Where's the demand for long-term treasuries going to come from if those people don't have dollars to recycle back into the treasury market? Mm-hmm. Where's the demand for stocks going to come from? If we just saw a record high inflow into U.S. equities over the last 12 months, and now foreigners are starting to unload those because of they're worried about the currency. And a weakening dollar, as I said, is a good leading indicator of stronger commodity prices and generally a higher inflationary environment. Stagflation, right? What's the best thing to do in a stagflationary environment? To own energy and favor commodities, real assets, natural resources. So I think all these things, as I said, kind of fit together into this broader theme.
Mm-hmm. So, taking that catalyst or source of demand, Jesse, for gold being the central banks, and now let's say adding this idea of the Fed possibly going, lowering interest rates, being far more dovish within, let's say, the next year, possibly going back to QE. Do you see that as another massive driver coming into this market for the price of gold? And, obviously as the measuring post, if the value of the dollar goes down, that is also positive for the gold price.
Yeah. I think absolutely longer term, gold has still plenty of upside ahead. Mm-hmm. I think in the short term, I think the gold price is kind of the canary in the coal mine for a lot of these things. It's already, I think the strength in the gold price is kind of already discounted. Some decline in real interest rates, some decline in the dollar that's already kind of priced into the gold price. So I think where the opportunity is a lot of these other commodities markets in the short run have not yet reflected these dynamics. And so gold is kind of the leading indicator, the leading edge. I think we probably, it's probably time for a lot of these other things to kind of catch up to the gold price. Longer term, yeah, I think, the gold price, the strength in the gold price is telling investors around the world, hey, look, if you don't own any gold, you're going to be in big trouble over the next, over the number of years, because it's going to be one of the most effective ways to protect your purchasing power in an environment where, the number one priority of the government is to devalue the currency. Mm-hmm. Is to make the debt affordable, we're going to need to lower interest rates below the rate of inflation. Financial repression is the order of the day. That's the playbook. Mm-hmm. That is the playbook. That's how you handle the situation that we're into now with debt to GDP, where it is. And so, the powers that be, when they're talking about trade deals and the overvaluation of foreign currencies, and all these other things, and the fiscal stuff they might as well be saying, under their breath, buy gold, buy gold, buy gold, buy gold, because that's the message, the underlying message, or should be, to investors for the way all these longer term things are kind of headed.
Mm-hmm. Well, Jesse, you mentioned the entitlements earlier, and this idea of the never-ending march, let's say, of the debt to GDP ratio at this point. Do you think that there ever comes a point where the government faces sufficient pressure to rein in this unsustainable spending? Or is that automatically, just always unpalatable, and they'll choose the inflation road instead?
No, there's going to be a time where things are going to have to be dealt with. It could be like a Liz Truss moment, where we see the long-term, bond market really take a nosedive, and you see, 30-year yield push 5%, 6%, 7%, even as you go into a recession. that would force the Fed, just like the Bank of England was forced to kind of come into the market. But it was also a very clear message to, the fiscal authorities to, like, you need to get your house in order. You cannot you cannot pursue these, any longer. A 7-8% fiscal deficit during a time of economic expansion is nowhere near sustainable. Mm-hmm. And so, if it doesn't play out in the bond market, and you say, okay, we're going to cap interest rates through yield curve control, it plays out in the currency market, and then the dollar really, really tanks in a major way. And so I think one way or another, you're going to see some type of a catalyst in the markets that does force it. Who knows when that would be, when that's going to come. But the fact that interest rates, longer term interest rates, are kind of going up on signs of economic weakness is not a good sign in that regard. Mm-hmm. And, the fact that the dollar interest rates going up, dollar going down, I mean, these are all signs of kind of like currency crisis, type light, mm-hmm. right? Early warning signs. And so I think it's headed in that direction. I don't know when it happens, but it'll happen. And it will, they'll be forced to probably do some combination of everything. We're going to have to, reform entitlements at the same time as raising taxes, at the same time as, just kind of a comprehensive package to kind of put things back to a more sustainable path.
Mm-hmm. Excellent, Jesse. Well, in kind of wrapping up here, what are you most focused on, let's say, understanding or keeping an eye on for the next 6 months here?
In the next 6 months, obviously, I'm a stock market guy, and the stock market is really kind of my main focus. I do think we could see, as I said, there's, major opportunity in the energy sector. And if I remember back to 2000, the NASDAQ peaked in March of 2000, rolled over hard. At the same time, the value factor started working really, really well. And so there were a lot of cheap stocks that started performing very well. I think we could see a similar rotation today, where a lot of the momentum favorites really, start to roll over. At the same time, you see natural resources stocks begin to benefit from these other dynamics. So I think watching the under the surface in the stock market, what's working, what's not working. If I'm right, then a lot of these themes will play out in natural resources stocks, and a lot of the high valued, high flying momentum names will really start to flame out.
Well, look forward to seeing how this progresses, Jesse. It's always a pleasure to spend some time with you. Of course, for anybody that wants to read more of Jesse's reports, you write a weekly kind of free newsletter with lots of charts and very simple, succinct explanations to kind of keep people abreast of what's happening, right?
Yeah, it's just a weekly free blog post I put out. It features usually 5 things that I found during the course of my research during the week. It could be an article, it could be a chart, it could be an interview. Things that I found most interesting during the week. And that's free to sign up for at thefelderreport.com.
Exactly. And of course, on Twitter as well, at Jesse Felder. Jesse, thanks so much for your time today. Really appreciate it.
Thanks, Tom. That was fun.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.